And the ESG panel is going to be run by our Chicago chair, Xiang Fan, and a spectrum of market participants, for example, from the exchange, from like index providers like MSCI, my company, and by investment firms like Legal and General, one of the largest pension fund in UK, and by academia, Professor Peng Ling from Baruch.
Morning, David.
Hey, how are you?
Very good.
Thanks for joining us.
Excellent conference.
Yeah, that's right. Yeah, Rick, good to see you. Sean, by the way, is also running for the board. And again, the TCFA members, please stay for the annual election at 11:30. So with that, Sean, the floor is yours.
Thank you, Dave. I think we have everyone. Jason is joining. Do you see Jason? Let me see.
Yeah, he's connecting in.
Okay, just wait 1 minute.
No,
okay, Jason's in too. Okay. Hi, everyone. This is Sean Fan, the TCFA Chicago chapter chair. We are starting the ESG panel with the introduction of moderator, Dr. Jason Wei. Jason is our former TCFA president. He is currently the associate dean at Tsinghua Institute of FinTech Research, director of China Insurance and Pension Research Center at People's Bank of China School of Finance. Welcome.
Thank you, Sean. Thank you, Sean. Thank you, everybody. Welcome to the panel on ESG, which I think is a very exciting topic today. We have a panel of top experts with very diverse backgrounds on this topic. So I'm very excited, and I hope you will enjoy this panel. So let me quickly just mention our panelists. We have Aaron Meador, CEO of Legal and General Investment Management America. We have a Professor Lin Peng, Creel Chair Professor in Finance at Baruch College, City University of New York. And we have Rick Marshall, Executive Director and a Senior Corporate Governance Analyst with MSCI ESG Research. And finally, we have Loretta Liu, Managing Director in Global Business from Wind Information, one of the leading financial information provider in China. So as you can see, our four panelists, they're all top experts in their fields. And the four fields overlap and complement each other very nicely. So I would like to start the panel by inviting Mr. Aaron Meador, CEO of Legal and General Investment Management America, to give a session keynote. And Aaron, very much welcome.
Thanks, Jason. Really appreciate the opportunity to be here. So hello to everybody, and thank you all for being here. As Jason said, my name is Aaron Meador, and I'm the CEO of Legal and General's U.S. asset management business. I'm joining you from my home here in Chicago, where it's been a long, interesting week, but happy to say we at least have some clarity now on who our next president will be. My comments today are about the future of the asset management industry, specifically how environmental, social, and governance issues, or ESG, will change the way we all invest money. I'll organize my remarks into three buckets. First, why will ESG become a widely adopted practice? Two, how will ESG be integrated? And I'll use a few examples from my business. And third, what we believe the future of ESG looks like. Before I dive in, I just want to give you a bit of, or just share a bit about where my perspective comes from. Legal and General is headquartered in London, It's one of the largest global asset managers in the world with 1.5 trillion in assets under management, mostly for institutional investors. I've had the privilege of holding multiple roles over my 10 years at L&G, first leading our solutions business, then head of investment for us globally, and now CEO of our US asset management business. Proud to say we're off to a great start in the US. We launched our business in the US a little over a decade ago, and we've been one of the fastest growing asset managers in the States. Gone from 0 to now well over 200 billion in assets under management. Our growth in business is driven by being a leader at three things: liability-driven investing, retirement income, and ESG. So why ESG? Part of the rationale is that we see the momentum building in the market, but it's also because it's perfectly aligned with what we see as the future of asset management, where the purpose shifts from a short-term risk and return and product orientation to one that is more long-term and solutions-oriented and helps address some of society's biggest challenges and opportunities. This shift in purpose recognizes the growing number of asset owners that are focused on not only risk and return, but also how their investments are impacting society. So I think we got the slides up here now. I think the cartoon on slide 2 kind of keeps it light here. I think captures this shift well. So you got a disheveled father sitting around a campfire with a distant image of a city in the background. He says to his kids, yes, the planet got destroyed, but for a beautiful moment in time, we created a lot of value for shareholders. It's our belief that working with our clients to address issues like climate change will result in a more inclusive and ultimately sustainable capitalist system, and therefore is in the best interest of investors overall. It's also our belief that large asset managers like ourselves need to lead the way on how we help asset owners deploy capital in a way that improves both investment and societal outcomes. So slide 3 shows several other key elements driving this rise in ESG. So let's start with the real economy. Everyday purchase considerations are shifting. There's an increased focus on environmental impact, healthy lifestyles, even downstream product considerations such as plastic waste and supply chains are influencing winners and losers in the market. Look at the rise of the electrical vehicle category or the success of healthy stacks. We also believe that certain pockets of social pressure, for example, the estimated 6 million climate protesters in 2019, are more organized, focused, and increasingly using their economic power via purchasing and investing to drive change. On the regulatory front, there has been sweeping global regulatory tailwinds supporting sustainable finance. Hundreds of country-specific incremental regulations have called for increased disclosure and explicit management of climate risk. In many respects, the United Kingdom is a leader. For example, the pension schemes bill specifically calls for board trustees to document that their pension is fit for the future with explicit consideration to climate risk. The demand for ESG investment products is also driving the market. For example, in the US, flows have been averaging about 10 billion per quarter, representing 10% of overall US fund flows, according to Morningstar. I've witnessed firsthand how the level of activity has picked up dramatically in the US over the past several years. On the data front, ESG has matured. The pure quantum of new data is staggering. There's an estimated 7 million ESG data points available on Bloomberg terminals. Importantly, the industry is starting to figure out how to best use this new data. For example, the Sustainable Accounting Standards Board, or SASB, deserves a mention. Their messaging about industry-specific material ESG metrics has resonated with both companies and investors, and has the great potential to become a minimum reporting standard. All of these drivers are just accelerating ESG adoption. Now I'd like to switch gears a bit and just talk about how we approach ESG on slide 4. The 3 pillars that drive our strategy are integration, stewardship, and solutions. Integration is how we use ESG information to make better investment decisions. This encompasses a range of actions from reviewing new sources of ESG data, formalizing how ESG information is shared across our organization, to conducting top-down thematic work, such as how will the energy transition ripple across and impact the market and society. Stewardship is how we use our influence to drive market improvements. The consolidation in the asset management industry has reordered and magnified the importance of investor engagement and proxy voting. We have an extensive public track record of using our market power to raise the bar on corporate governance practices, to increase the long-term value of our clients' assets and enhance market resiliency. And solutions is how we build products to solve problems. This is about working with clients to balance risk, return, and social impact considerations, making trade-offs transparent and carefully matching objectives with optimal implementation. Now I'll go ahead and just wrap up with what we're doing to address 2 of society's biggest challenges, climate change and diversity. Starting on slide 5 with climate change. We launched our flagship environmental campaign, what we call the Climate Impact Pledge, 4 years ago. We selected companies in climate critical sectors, such as energy and transport, assessed them using data from specialist providers, as well as conducted in-depth engagements. On an annual basis, we celebrated positive changes in leaders and sent a message to laggards through voting and divestment from sustainability-focused funds. We call this approach engagement with consequences, and it works. We have tracked companies following our engagement. For example, Japanese automaker Subaru, US energy companies Dominion and Occidental. We publicly recognize these companies for taking substantial positive policy and operational steps and remove them from the laggard list. Our program has received extensive market recognition from groups such as PRI and Morningstar. This year, we are expanding the Climate Impact Pledge in both number of companies and industries. We are now including 1,000 companies and expanding into sectors such as cement and buildings. This enhancement is possible because of improved ESG data and also making better use of technology. Now, on slide 6, I'll move on to diversity. We've been longstanding advocates for cognitive diversity in the companies in which we invest. There is substantial academic and market research that links diverse corporate leadership and workforces with many beneficial characteristics, such as better decision-making, more innovation, and the ability to attract and retain high-quality talent. Over the last 10 years, we have leveraged our influence via engagement and voting to significantly improve the gender balance of companies. We are now turning our attention to ethnic diversity. This fall, we issued a thought piece that outlines our expectations of companies on ethnic diversity. Additionally, we sent letters to the board chairs of 44 S&P 500 companies, as well as 36 FTSE 100 companies, whose board membership shows a total lack of ethnic diversity. An example of one of those letters is on this slide. We are asking companies to capture and disclose ethnicity data at 4 levels: board, executives, management, and workforce. In addition, we are asking these companies to have minimum of 1 non-white director on the board by 2021. From 2022, there will be a voting sanction against the board if they fail to meet our expectations on ethnic diversity. So I've focused here on climate change and diversity engagements, but I have similar examples across a growing list of ESG considerations. The quality, precision, measurement of our actions is increasing each quarter. And going forward, our priority is to further link our actions, analysis, and the development of ESG solutions. We believe this is the future of ESG. This means if a company is discovered to be a laggard in regard to operational carbon emissions or lacks any ethnic diversity on the board, we use the strength of our stewardship team to drive change. Our investment research analysts are made aware of these deficiencies and can track progress in real time. And ultimately, our solutions team is able to design even better custom investment solutions for clients that have ESG-oriented investment objectives. This type of full organizational ESG integration takes time. I can't say we're 100% of the way there, but we are a market leader and making great progress. And I'll stop there, Jason, with my opening thoughts.
Thank you so much, Aaron. Yeah, this is definitely a great story and great insights about how important ESG is to long-term institutional investors. And I fully agree with you when you talked about, the shift in multiple aspects in the investment world and people's behavior and proactive engagement. I thought that was very, very important from investors' perspective. And also, I fully agree with you when you said it takes time because this engagement, this accumulating more information and digestion, getting an understanding about a new dimension that's important for investment, it all takes time. So that's why I want to turn the channel to Professor Lin Peng, who has done a great amount of research in corporate governance, including ESG. And Professor Peng has been a tenured professor, chair professor at the Zicklin School of Business, Baruch College, City University of New York. And she has published extensively in top journals, and she's sitting on multiple journals editorial committees. We know that the concept of ESG can be traced back all the way to UNPRI time, which was initiated nearly 15 years ago. So I first ask Professor Peng, would you share with us, the collective wisdom on ESG in the past 15 years, based on your research work, and what's the latest of people's understanding about this concept?
Absolutely. First, thank you, Jason. Thank you, David. Thank you, TCFA, for giving me this opportunity to share my thoughts with all the other experts in the area. Well, actually, can I share my screen? I actually made some tweaks in the slides, so if I can just share the screen on my side.
Sure, please.
Yeah, okay, great. Okay, there we go. Can you guys see it?
Yep.
Yeah. All right. Yeah. So absolutely. So this is an excellent session, and I will give an extremely brief view of ESG around the world, history, present, and the future, as Jason was asking. So my name is Lin Peng. I'm a Kraut Chair Professor in Finance at Baruch, City University of New York. So it's good to join the panel and to see some old friends at TCFA in the audience. So, so actually, the concept of ESG relates to even a broader history of a longstanding debate on what is the purpose of a corporation. So the Nobel laureate Milton Friedman had very extremely influential article published in the New York Times in the 1970s, referring to as the shareholder theory. It's also often referred to as the Friedman doctrine. Okay, so what Friedman proposed is that a firm's main responsibility is to its shareholders. Okay, which means that the social responsibility of the business is to increase profits. Okay, so this line of thinking has significantly impacted the corporate world in the the many decades afterwards, including what we mean by shareholder rights, how do we design the right executive compensation contract, what is the right way of pursuing corporate governance, and the social responsibility of the business. And in fact, in 1997, the Business Roundtable, which is an extremely influential organization comprised of CEOs of major US companies, they issued a statement echoing the Friedman doctrine. Okay. However, in the last 20 years or so, this line of thinking has been under attack because of the wave of the stakeholder capitalism. Okay, so interestingly, in 2019, so the same Business Roundtable has issued a new statement stating that, well, actually now a company's primary responsibility is to owe its stakeholders, so not just for the shareholders. Okay, so and the reason for this change in investors' emphasis on ESG is because they are now increasingly concerned with the corporate sustainability in the long term, with UNPRI, one of the major driving force behind it. So as Jason mentioned, if you look at the number of organizations who are the UNPRI signatories, it's since its establishment day, a year of 2006, it has 63 signatories and involving assets under management about $6.5 trillion. But as of this year, the number of signatories has grown to more than 3,000 institutions and corresponding to a asset under management of more than $100 trillion. So, and in addition, there has been exponential growth in the amount of ESG regulations. So if you just look at 2018 alone, there is close to 200 proposals, regulation proposals proposed, affecting about more than $30 trillion as amount under management. So below the three squares, the three circles basically highlights the key issues that UNPI considers important in terms of environmental, social, and governance. So I will not go into details because of the time constraints. But let me take one step back, right? So why are investors interested in ESG in the first place? Okay, so there are two main reasons. The first reason is, of course, we all want to live in a better world, right? So there's this natural ethical concern with, what is the impact of the corporation in the society at large. So the view now is that the goal of the corporation is to encompass its impact on a broader constituency, including all the stakeholders, the employees, suppliers, the local community, and the environment. Okay, so this is explicitly pointed out by Larry Fink, the CEO of BlackRock, in its annual shareholder letter, stating that every company must not only deliver financial performance, but also show how it makes a positive contribution to the society. Okay, so the other line of thinking is actually consistent with the Friedman doctrine in the sense that we've heard this word a lot, right? A company can do well by doing good. So the idea is that even if the goal of the corporation is the shareholder value, given that it's really the long-term shareholder value that matters, and ESG is viewed as a tool towards that goal, right? So if you think about employee commitment, when you have happy employees, they tend to be more productive, they are more innovative, it's good for the company's reputation, reduces litigation cost, regulatory cost, and avoids scandals, right? And one particular maximum design to align companies' interests in the long-term sustainability is through ESG contracting. So basically it is referring to the practice of specifying a particular explicit component in the executive compensation contract that's tied to ESG. And I'll be happy to share some of my research along those directions, okay? So first, if you look at the long-term, the historic trend in the number of companies adopting ESG contracting for its top executive officers, there is a substantial increase over the last 10 years, okay? Especially for the developed countries. So nowadays, every 1 in 5 firms actually do have explicit ESG goals in the way they compensate their executives. Okay, it is therefore a very important question in the designing of optimal corporate governance contracts, right? But however, the view on the effectiveness of such contracting has been mixed, at least from the academics' point of view. So the proponents argue that while integrating ESG into business decisions are fantastic because they enhance both the social and financial performance of the firms, on the other hand, the skeptics say that, well, these compensations, they might be a reflection of agency issues, right? If some of the performance goals are opaque and hard to measure, and therefore they can be manipulable by the management team, or it may be a form of what's called a greenwashing, meaning it's a symbolic gesture to make the company's annual reports look pretty, but they do not have any actual impact on the firm's business decisions. Okay, so what we do in this research is we conduct the first large-scale global study that investigates what are the determinants and outcomes of ESG contracts. Okay, and I have to pay my special thanks to David and Rick for giving us some data that's been used for our study. So just to show you some very quick pictures. Here we looked at the percentage of firms across different industries that has adopted ESG-linked pay. So as you can see, you can see two things. First, pretty much across all the industries, there has been a substantial increase in the percentage of firms that's currently using ESG pay. Okay. On the other hand, you can also see substantial differences across industries. So in general, the extractive industries tend to have a greater percentage of adoption in the ESG-linked pay, particularly in the mining, oil, in chemical, and in the utility companies. Okay. Now turning into cross different countries. So here we basically group countries by their geographic locations in terms of continents. So as you can see that the European countries tend to have a higher adoption rate compared to United States. And also the Asian countries adoption rates, they are increasing, but they are still substantially lower compared to the other countries in the world. Okay, so just to give you a very quick takeaway of our findings. So our findings are consistent with the notion that if you give the CEOs ESG-linked contracting, that's going to help direct management's attention to stakeholders. It's going to help mitigate the management short-termism and enhance corporate governance and firm value. Specifically, we do show that when a company starts to adopt ESG-linked pay, it does increase firm value and also increases the profitability of the firm. Okay, we also find that the ESG practice of a company is actually, it's not black and white, it's highly relevant depending on the regulatory framework of the country, depending on the societal norm of that country. So we find that the adoption rate is higher for countries who value individualism, who gives more shareholder protections, and the countries that has lower corruption. Okay. On the other hand, we find the adoption is less likely for the masculine and the countries with civil law origin. Okay. And finally, if you want to look at firm characteristics, we show that large value firms and firms with high ESG scores, they are more likely to adopt ESG contracting. Okay. So I want to end my talk with the last slide, which is about what are the important issues that impose challenges and perhaps opportunities for investors in the future, right? So the first issue is that despite of the importance of ESG, it's actually extremely difficult to measure. Okay, so a case in point, a recent working paper by MIT professors has shown that they've looked at ESG ratings across 6 prominent data providers, and they show that the correlation between the ratings is extremely low at about 30%. Okay, so what does this mean? Well, to give you a comparison benchmark, if you look at the bond ratings, by S&P or Moody's, the bond rating correlation is actually 99%. Okay, so what does this mean? What should investors do when they look at this host of different ratings? Okay, that's the first issue. The second issue is that, again, the ESG practice is not black and white. You have to understand the trade-offs a firm faces, right? So for example, closing down a polluting factory is great for the environment, great for the local community, but it also means that a lot of workers will be laid off, right? So what are the trade-offs that the firms have to balance in considering these initiatives? Okay, and the third point is that sometimes we see a lot of findings saying that, hey, for example, companies with happy workers, they tend to have better valuation, they tend to do better, right? So I think investors want to sort of take one step back and think about it, right? So what does this mean, right? Does that mean that ESG improves firm value, or does it mean that, well, maybe just because of correlation, right? So good firms turn to have happy workers, and at the same time they can also afford to do ESG. Okay, but the bottom line is that I think all the investors, not just the socially responsible investors, obviously, I hope all the investors are socially responsible, right? But even if your goal is not just on the social responsibility, right? You should all take ESG factors seriously, right? Because these factors, they sometimes may be dismissed as non-financial factors. There's been increasing more evidence that shows that they often become financially material in the long run. Okay, and also following yesterday's news, right? So if our president-elect Biden is going to take off, start his term early next year, U.S. is likely to rejoin the Paris Accord, and that means that a lot of these climate and environmental regulations is going to be restored or even bolstered, right? And that also implies there's going to be massive investment in clean energy research and development. So I think there's a lot of opportunities for investors. Okay, thank you, Jason. That's for now.
Wonderful. Thank you, Lynn. Yeah, I think based on talks of Aaron and Lynn, there are several things very clear. Investors are increasingly taking it seriously, and companies are increasingly adopting measures reflecting ESG. There are a lot more data points, but at the same time, we see a great variation across different countries, different markets, how companies understand and adopt the concepts and implement, ESG-related incentive schemes, and investors accordingly how they understand the value of ESG practices. So I want to turn a question to Rick Marshall on this, I think, a very important practical issue. And Rick is the executive director at the MSCI ESG Research. And as we all know, MSCI is world's leading analytic shop in ESG, and with this very famous ratings being adopted by almost every major investor. So my first question to Rick is, how has the adoption of ESG ratings? This is a very important measure to help investors and the companies to better understand which aspect is more important. How has that adoption been evolving over the years? And accordingly, how has the rating methodologies been evolving over the years to better reflect the need from both the market and companies?
Okay, great. Thank you, Jason, and thank you, David and TCFA for inviting me to join this terrific panel. I'm going to answer your question by building a little bit and sometimes touching on the presentations that we've already seen, which really hit some of the key points around how ESG investing, and in particular the use of ESG ratings, has evolved and developed, and how it's practiced. I find it helpful to think of current ESG investors as falling into one of three broad categories. Now, these are often very complementary and implemented in various combinations. So this is just a helpful point of entry. But first of all, and we've already heard some of these terms. First of all, they're the traditional SRI, or socially responsible investors, also known as values investors, who are focused primarily on aligning their investments with their particular beliefs and values. Exclusionary screens remain a primary tool for such investors. But the better known investors in this group, like firms like Wellington and Calvert, have been developing this approach over many, many years. Secondly, as we heard from Aaron, there are those investors who are focused on ESG integration, or more effectively, managing their long-term macroeconomic risk. Many of the larger public pension or sovereign pension funds have allocated most or all of their assets to this approach, as have many of the largest managers, not just Legal General, but including BlackRock, including UBS, and so on. The list goes on. For this group of investors, the emphasis is not on values with an S, but rather on value, on shareholder value, on improving investment returns, and that's how they use ESG. I'll get to the specifics of that in just a minute, but the third category that we're seeing emerging with increasing importance are known as impact investors. Still focused on investment returns, of course, but strongly committed to putting their capital to work specifically for positive impact. In many cases, these investors are using the PRI Sustainable Development Goals. And some examples in this category would include firms like Vital Capital or Blue Orchard Finance. But in fact, many of the larger pension funds and other asset owners and the largest asset managers who are focused mainly on ESG integration may also be developing or have launched various kinds of impact funds as well. So we see these in different combinations. As we've already heard, SRI investing is the oldest of these approaches. Just earlier this year, in fact, MSCI celebrated the 30th anniversary of the first modern SRI index, now called the MSCI KLD 400 Social Index, which was first launched in May of 1990, but is still in active use. Of these three different approaches, ESG integration, where investors are focused on integrating ESG research and assessments, ESG ratings, throughout their investment process, is by far the dominant strategy, and also the most rapidly growing. This is where we see the most pickup. Current ESG integration strategies span a broad spectrum of goals and objectives, including the mitigation of long-term systemic risk, such as carbon or other climate-related risk, a reduction of risk caused by changes in the market economy and the global economy, including, of course, the sort of global ESG crisis we're experiencing now in the form of the COVID pandemic. And then finally, there is the challenge of identifying stock-specific portfolio risk and opportunities. Investors approach the integration of ESG in a variety of ways, of course, but the primary goal these days is not so much alignment with values, as we saw with the rise of SRI investing, but rather the improvement of investment returns. In our recent Foundations of ESG Investing series, we found that higher ESG rated companies tended to show higher profitability, higher valuations, and lower risk exposures to ESG controversies. In another recent study, which included a deconstruction of returns by individual ESG pillars, that is the E, the S, and the G, we found corporate governance to be the strongest contributor to higher returns. But in fact, it was the overall combination of all three pillars in the form of our ESG ratings that provided the strongest investment signals. So let's talk about ratings a bit. I've been involved in the business of rating companies on corporate governance for over 20 years. In the context of ESG, about 10 years, and I've been with MSCI now for about the past 6 years. Interestingly enough, many of my colleagues at MSCI actually have a very similar history, having started out many years ago at other similar innovative small companies like my own. Ultimately, these companies were all merged together and acquired and rolled up into what we now know as MSCI ESG Research, which, as Jason said, is the leading provider of ESG ratings. So our ESG ratings reflect a very rich history, and our approach to ESG is based quite literally on many, many years of hands-on experience, experimentation, testing, and we finally settled on what we think is an effective model. And just stop and think how far we've come in this regard. I mean, it wasn't so long ago that we were all still learning how to use spreadsheets. We were reading printed annual reports and casting votes by paper proxies. Whereas today, what we think of as ESG data is derived from a huge variety of mostly digital data sources. Company disclosures, of course, including annual reports, sustainability reports, proxy filings, and the like. But at MSCI, we also access all sorts of additional external and public data sources, including specialized academic, government, and NGO data sets, and more than 3,000 global and local news sources, which we scan on a daily basis. In fact, only about 35% of a company's rating at MSCI is based on voluntary corporate disclosure. The rest is all derived from these other sources. And of course, we're increasingly turning to AI and machine learning and other new emerging technologies to improve the depth and reliability of this data even further. We've also developed a very rigorously designed framework for classifying and using this data, a standardized framework that supports the assignment of ESG ratings now to more than 7,500 companies globally, actually more than 13,000 companies if you count all of the Mappables subsidiaries and the private firms that we monitor. Most importantly, however, the approach that we have devised to create these ratings has been designed to reflect the unique circumstances of each individual company, while at the same time being fully scalable for that entire coverage universe. How do we do this? Well, first, we determine what ESG exposures are most material to a particular company. And that's based on a combination of looking at their industry, where they're operating, and also their actual revenue mix. We look at their financials and try to determine where is the most exposure in terms of ESG. We call these exposure categories our environmental and social key issues, of which there are currently 35 employed in the ESG ratings model. Environmental key issues would include things like carbon emissions, climate change vulnerability, water stress, biodiversity and land use, toxic emissions, and waste. Social pillar key issues would include things like human capital development, critically important in the context of the COVID-19 pandemic. Health and safety, supply chain labor standards, and privacy and data security. As I say, there are 35 key issues in all. But once we have determined which key issues are most material for a particular company, we then conduct an assessment of their effectiveness in managing those specific risks. It's this key issues-based approach which first identifies their exposure and then evaluates their management of those exposures that helps ensure the materiality of our ESG ratings, and also which allows for their comparability across different sectors and industries. I mean, you stop and think about it, the ESG key issues that are most material for a mining company are going to be very different from a retail company, and different again from a utility company, and different again from a financial company, and so on. The governance pillar, however, which is where I'm mainly focused, is treated quite differently in our model, in part because governance is a universal area of risk and concern that's applicable across every industry, but also because governance tends to vary on the basis of a company's home market. Local governance standards have a big impact. And also we look at a company's ownership structure, especially when there is a controlling shareholder involved. We find that governance structures need to be evaluated very differently when a company is widely held and widely traded, as opposed to when there is a concentrated ownership, maybe on the part of a founder or a family. So our governance scoring model has been developed to make those allowances. And then we combine that score with our E and S key issue assessments to create the overall ESG rating. This is the key to our trying to address the question of materiality and make these ratings as meaningful as possible. Ironically, of course, one of the most important benefits of having access to a really reliable standardized data set and a rigorously and transparently managed ESG ratings model is that it in turn supports an incredibly diverse range of investment approaches, from active managers holding a relatively small number of individual equities to ESG-based ETFs that actually look at an investable market with hundreds or even thousands of different positions. This approach we found works well for traditional SRI investors focused primarily on values, but also for ESG integration, and ultimately positive impact investors as well. And we also are increasingly able to apply it not just to equities, but for fixed income and even real estate investors. And then finally, I just want to touch on another, what I consider an integral part of ESG investing.
Rick,
yes.
Sorry, Rick, we might have one more minute as we have another speaker, not a wind, but another session after us. That speaker is going to do that from China side. So
okay, I'm sorry. Let me stop there then.
We'll have we have one more minute for
one more minute.
Part. You're going to talk
okay.
about integral part. I want to hear that.
Okay, very good. Well, Aaron touched on this, and it's the question of stewardship. ESG is not just a question of picking the right stocks. It's also about the maximization of value through stewardship and active engagement. Contemporary ESG investing is very much driven by the dynamics that occur at the intersection between companies and the world, between society and the global economy. And all of the various stakeholders involved. We've heard this reference to stakeholders. Only shareholders are entitled to vote or have a legally binding fiduciary responsibility to do so, which makes ESG investing and the role of shareholders incredibly important. For many ESG investors, and especially for ESG index investors in listed equities, this commitment to ESG investing is also a commitment to active stewardship, to becoming an active owner. And that is my ending.
Great. Thanks so much, Rick. Yeah, I think that's good news. We have a more and more sophisticated methodologies. That's good news for Aaron and Lynn. But I still agree with what Aaron said. It's going to take a long time for everybody to better understand and utilize this measure. And we have Loretta Liu, Global Business Managing Director, Assistant to Chairman of the Board at Wind Information. I think it's very important that our session touches on China, this very important market where we're seeing rapid pickup on ESG methodology and considerations by both companies and investors. So Loretta is going to talk about how has China's capital markets embraced ESG and what's Wind's outlook for ESG going forward. Loretta, please.
Thanks, Jason, for introduction, and thanks for our panelists for sharing. I would just keep my talk short and neat from 4 perspectives on the market development of ESG in China, the asset allocation, investment return, and the current challenges. So as you may see from the page, the Chinese ESG market in fact started late and developed slowly. The asset management firms, in fact, only 6.1% are currently applying or having mature strategy in ESG. And on the left, they're still watching the market to be developed. And I listed some policies from the government and the stock exchanges on their guidelines for firms and the markets to follow the ESG trend dated back to 2006. I will skip this part, and you may say the government are pushing hard to let the market adapt to this concept. The Chinese market started to adopt the ESG concept from when the Chinese Asia market opened to the global market, and then more and more institutional investors having their interest in the environmental protection, one of the ESG concepts. And then there's, as we look forward, there will be larger investment in this ESG sector. For the asset allocation, as you may see from the page, started from the top right corner, 46 institutions are currently signed for the PRI guidelines in China. And the total scale of ESG theme-related fund exceeds 120 billion Chinese yuan, which is almost equivalent to 17.1 billion US dollars. And for now, the investment vehicle is quite diversified from the stocks to fixed income, as well as some funds. Previously, I saw from the Q&A board, audience is asking a question related to what if the ESG index is underperformed than the benchmark? My reply to that question, that shouldn't be a worry in Chinese market. As you may see from this page, in fact, ESG index outperformed than the benchmark. And the exact number is the annual rate of return of ESG index in China was 18.3% in the past 5 years, which is 7.8% over the benchmark, and up to today, the annual rate of return of ESG index was 32.2%, which is 9.3% over the benchmark. As you may say, the gap between the ESG index is getting larger and larger from as time goes by. So for all the believers and the pursuers of ESG concept, Chinese market is a good field for you to test your strategies. For the investment return, as we may say, the return of hybrid fund and the stock fund are relatively high. And for the excess return, the bond fund and stock fund are relatively high. Well, the disclosure, as many of the panelists has mentioned, for the data ratings and the company disclosure, the requirement in Chinese market is semi-compulsory and voluntary. So the investors, they have some challenges when they're making the decisions for the lack of engagement from the companies, and these companies, their lack of motivation to disclose themselves. And also the current market, they're lacking of some disclosure standard and evaluation standards, which makes the ratings lack of credibility. These are all the challenges in front of the investors. And for the, as you may see from this page, for the CSI 300, which are the blue chips in Chinese market, this constitutes companies, the numbers which disclose the ESG report are relatively low, which is around 2/3 of the total numbers. While the number of the Asia listed companies which disclose the ESG reports are getting higher and higher as time goes by. Up to today, there's a total of 4,012 listed companies in China, and almost 25% is 25% are currently disclosing the reports.
Yeah, Loretta, we might have to wrap up in 1 minute. I'm sorry.
Okay, sure.
Yeah.
I will keep it
Thank
short.
you so much.
So my last minute is about why wind, because we are giving our institutional clients, the next page, please. So over 90% of financial institutional investors are using wind as their data vendors. And for the ESG, it's also, it has to be wind, because we have a one-stop platform and offer our clients with the metadata And our coverage, including the ratings, index development, product display, and the fund product issuance and sales channel. And we have the exclusive surveys for the third-party ratings from FTSE and the Chinese mainland ratings, Central, Grain, OWL, etc. Our mission is to pass the ESG value from secondary market to the listed companies and from primary market to startups. We want to share this vision and mission and make people more and pay more attention to the ESG thing and the concept and then making it better. If you're interested, you're welcome to contact us with the following links and or join us with the WeChat group. Thank you.
Thank you, Loretta. Yeah, we're coming to the end of the session. I want to thank all speakers for a wonderful session. Definitely look forward to further discussing this in the next year's annual conference. Thank you very much.